Welcome back, students. In this exercise, I'm going to explain to you what we call intercompany transactions. Okay, I will get to it and I will explain to you how we deal with them. Okay, now let's start from the beginning. What we always do, the company is bought here. They bought 112 out of 160. All right. According to the information given to us, we are supposed to do the analysis of equity of Ken. Ken is a subsidiary. Always the analysis of equity, you are doing the analysis of equity of a subsidiary, meaning you're only doing one company, which is this one here, right? Which is this one here. So you must concentrate on Ken, not the other company, which is Ben, when you are doing the analysis. Now, the analysis of equity is this one. It's divided into three. This is date number 1, and then this is date number 2. This is date number 3. So it's divided into 3, right? So we're going to start with the first one, which we call at acquisition. When we are buying the company, meaning when Ben buys Ken, what was the equity? The equity of that company was 160. There was a 40,000. There was an 80,000 here, right, when we bought the company. So how much did we pay for this company? We paid 190, right? So at acquisition, we've already established that if you've got 112 shares out of 160, you've got 70%. 112 divided by 160 will give you 70%, right? So we do at acquisitions. So we've got 160. We apportion it to 70% here, 30% here. Then we've got 80. We apportion it to 56,000 here, 24,000 here. Then we've got 40 here. We apportion it to 28, then 12 here. Okay. Now, when you add everything, here it gives you 196. Here it gives you 84, right? So this side is 280,000 when we add everything. Now we go back and check. Okay, how much did we pay for this investment? We paid 190. Okay, you can see here at acquisition it was 190. It's still 190 even after that, meaning in the current year. So we paid 190 for something that is 196. The net asset value is 196. We paid 190 for it. So we have a gain on bargain purchase, right? We come to non-controlling. We've got 84,000. There is nothing that is being said about the fair value, so we don't adjust. We end up at 84, right? Now here, because it's 0, this one, we've got a 6, which is a gain. So in total, our gain is 6, right? That will take us to 274. All right. Now, what you then have to understand is that now then you need to move to date number 2, which is this one here. That is our date number 2 in analyzing this company. So what you do, you go here, you check, okay, when I was buying this company, I had 160 in shares, meaning share capital. I still have 160 even this year, in the current year. Okay, nothing changed. Here I've got 40,000. I still have 40,000 here. Nothing changed, right? Here I've got 80, but now I'm sitting somewhere at 160. So there's a movement from 80 to 160. So the money that was earned while I was here, or meaning while I was part of the company, is 80,000, right? Now you go to check here in date number 2, the movement. Remember I said date number 2 is beginning of the current year, or you can say closing of last year. Now you can see the calculation. I've got 160 in retained earnings, but when I acquired the company, I found the company with 80,000, which is this 80,000 that they are showing. I found the company with 80, so I'm only entitled to 80 as Ben. But of the 80, someone must take their portion, and I will take my portion. So Ben is entitled to 56, meaning 70% of the 80. And then non-controlling will take 24,000, right? So then in total, by end of that period, it's 345. sorry, 354. Here it's 90. The post-acquisition retained earnings that Ben has earned is 56,000. Your non-controlling by that time they're sitting at 108,000 before the current year. Then we move to the current year. All right, we move to the current year. In the current year, which is date number 3 now, it's this one. We go here. If you add everything from here to, I'll take it to where I want to here. Everything I've highlighted here. If you add that, it will give you profit after tax. And the profit after tax that you are going to get for Ken Limited, if you add everything there, add and minus everything there, it will give you this amount. Here it is. Right. This amount, which is the amount that we are showing here. Okay. Now, unfortunately, we didn't show the calculation here. We're just giving you the final figure, then we're transferring it. But I've showed you where we're getting that figure from. Now, that 93,200, Ben will take it 70%, and then non-controlling will take their 30%. Okay, non-controlling will take their 30%. Now, if you go to this part here, Ken declared ordinary dividends, right, of 40,000. So if Ken declares ordinary dividends of 40,000, which is this one, in some questions there's interim and final, so you add them together. Okay, some questions they'll say interim dividend is 10,000, final is 20, so in total your dividend is 30,000. Okay, so in this case, Ken declared a dividend of 40,000. When declaring the dividend of 40,000, 70% goes to Ben, which is 28,000. And then the other 12 is to non-controlling. Right, by end of that period, you should be sitting with that amount of 4,7,200, 190 here, 93 to 40, it's 123,960. Then you have dealt with your analysis of equity. Now, what then you have to do is to then look at the next requirement, which is this one, statement of comprehensive income. Now, before I do anything on this thing here, let me just firstly highlight figures that are here so that we can all understand. Here is the revenue, 1 million, and then it's 500 here. Then I come here. Here's the 1 million and the 500,000. Let me do this. Here's the 1 million. Okay, and the 500,000. So you'll see here we've got 360 and 300. Okay, and let's show you. Here's 360 and 300, which is cost of sales. Okay, then let's go to other expenses so that we just highlight figures that are there. In other expenses, there's an 80 and a 60, which is these two. There we go. 80 and 60. Here they are. These two. Right. Then we have 8. We're gonna have an 8 and a 9 in expenses, which are these two. Let's go check. 8 and 9, here they are. 8 and 9. Right. Then we check, there should be a 24, which is this one here. There's nothing on that side. 24, here we go. Was the 24 here? Here we go. Right, 24. All right. Let's go to other income. I'm leaving the two that I've not highlighted in other expenses. I will explain them. Let's go to other income. Other income. We should have this 36 here. 36. And then we should have the 12 and the 14. So it's 36, 12, and 14. Let's go. Yeah, here they are. 36, 12, and 14. Okay. Boom. All right. Then we come here. There should be a 36 and a 10. Here they are. 36 and 10. $36 and 10. All right. Now then, obviously these two, I've also obtained them by adding the two. Where are they? Here are the two that I've added in taxation. Okay. Now, I've tried to explain figures in terms of where they come from on the other side in terms of the question itself. Okay. Now let's deal with this thing called intercompany. I'll give you an example in terms of this thing here so that we do it one by one. You see this transaction here. Ben Limited offers administrative duties to Can. Now, Ben is making 2,000 a month. In a year, it's 2,000 times 12 is 24. So Ben is making what we call administrative fees income or received, something of that sort. But it's income, whatever that is making. And then Ken has got what we call an administrative fees expense. You get my point. But now, what you must remember is this. If we can analyze the two companies, let's look at the administrative expense. Ben, here's Ben. You see Ben here has got an administrative fee of 36,000. But in that 36, there's a 24,000 that was paid by Ken, right? And here, Ken has got a 24,000 administrative fees paid. This expense was paid by Ken to Ben, right? But now the rule of consolidations are that if you combine the two companies, meaning you're making a group now, you're consolidating. If you combine the two companies, Ben will bring in 24,000 in administrative fees income. Ken will bring in 24,000 in administrative fees expenses. But then the rule of consolidation says intercompany transactions must be eliminated. You only eliminate, for an example here, you see here there's 36. I can only eliminate 24,000 because 24 is between the two of them. You don't go and eliminate the whole 36 because it's not 36 that is between the two of them. It's only 24,000, which is 2,000 times 12. That is between the two of them. You can only eliminate that amount. Now, the rule of consolidation says if you consolidate, you must always eliminate what is intercompany. Now, let me show you here. You will see here, under other income, we are minusing 24,000, which is the income that Ben is bringing. We're saying minus it, take it out of the books because it's intercompany. Then we go to Ken and say Ken is bringing an expense into consolidation of administrative fees expense. We're eliminating it. You see we're deducting it here. Right. Here. Now, the rule of intercompany is that if the two companies are trading between themselves or there's a transaction between the two, when you consolidate, meaning when you combine the two companies into one, you go and eliminate what is intercompany, right? Let's then go on with this thing of intercompany. Let me show you something else. You see this company here? Ken borrowed 50,000 as a loan at an interest rate of 15% per annum. Okay. Now, What you then need to do is, if you look at this interest here, how much did Ken pay as interest? 50,000 times 15%. But be careful, because this whole transaction was entered here in June. So half a year times 6 divided by 12. Okay, times 6 divided by 12. You'll see it's a simple calculation. 50,000 multiplied by 15%, multiply by 6 divided by 12 equals to 3750. Okay, let's go here. Right. So Ben is going to pay, no, Ken is going to pay interest. See, I think this one we're supposed to expand. Ken borrowed 50,000 from Ben, because as it is, it doesn't say much. It must be specific. Ken Limited borrowed 50,000 from Ben as a loan at an interest rate of 15% per annum. Okay, so we know, right? It should be like that. Now, if that is the case, so Ken is going to pay 375 as interest to Ben. Ben is going to have an interest income because he's going to receive that money. But when you combine the two companies into one is bringing interest expense, one is bringing interest income. But the rules of consolidation says, on consolidation, you can see here, here's the interest income, here's the interest income. Let's do this. Let's get out of this. Right. Here's the interest income and the interest, so the interest expense and the interest income. So when these two companies, you consolidate them, we are bringing the interest income from one and the interest expense from one. But the rules of consolidation says, if there's an intercompany transaction, you must eliminate it. So I'm going to eliminate 3750 in income, which is the income that the other company is bringing. And I'm going to eliminate 3750 as in expenses because the other one is bringing an expense. So an elimination of intercompany must be done twice. You must eliminate one side from the other company and one side from the other company. Okay, you do it twice. So there must be one leg and then there's another leg. Now let's deal with something here. Now let's talk about this thing here. This. Right. So when Ken declares a dividend of 40,000, 70% of it he pays to Ben, 30% of it he pays to non-controlling, which is 12. Now, do you notice something, that when this 28,000 is paid to someone within a group, it's intercompany because it's from Ken to Ben. It's intercompany, right? Ben will show a dividend income when Ken is showing a dividend expense or dividend declared. Okay, so the 28,000 is intercompany, meaning if we go to the company Ben, if I go to Ben and I'm dealing with this money here, this dividend income of 36, in that 36,000, there's a 28,000 that comes from Ken, the subsidiary. In that 36, there's a 28. But what does what do the principles of what do you call this thing, of intercompany say? They say on consolidation, you must eliminate the transaction. Okay. Right. Now, this 28, like I've said, is intercompany. It must be eliminated. That is why you see it here. You see, there's a minus 20. You eliminate it in income, right? And someone else will come and say, okay, fine, I'm eliminating 28 there. Where is the other leg? The other leg is somewhere here. It's sitting in this. You see this 60. Right, let me show you. Let's do this. Let's go up here. here is your declared amount, 60 and 40. Okay, right. Now let's deal with it. Let me show you so you can understand. So I've got 60,000 plus 40,000 minus 28, which is intercompany, isn't it? There. I've minus the 28 here. Then I'm going to dividends declared. I'm minusing the 28. Right. Right. Then of this amount here, 40, 28 went to intercompany. The other 12 went to non-controlling, which is this one here. Here it is. This 12 here. It went to a different type of shareholders, which is non-controlling. It's this 12 here. Obviously, it carries to that side. So the reason why you see now that thing showing 60,000 here is because this is what happened. It's at 60 plus 40 minus what is intercompany minus what went to non-controlling. We are left with 60 as a group here. That is why here we are declaring 60. But sometimes to get around this thing here, or to make it easy for yourself, always put the dividends declared by the holding company, meaning this one that bought the other one. Always put this one, the dividend of the holding company, because this one here will be eliminated, because this one is made up of intercompany and non-controlling, and you must eliminate them every time. So you'll always remain with the dividends of the dividend of the holding company here. So I was just showing you how we went about getting this figure. Okay. Now I've showed you the 28 here, right? So now you will calculate everything here, add your figures. They will give you the figures that you see on this side here, right, until you get your profit to be 511,600. Okay. Then what you then do is you must split this amount into owners of the parent and non-controlling. Okay. Now the first thing you do, you come here, you look at date number 3. See this line here in date number 3, this line that I've highlighted. Look at the non-controlling figure, which is this one. Always you must reflect that figure. Date number 3, in line with current year's profit, you must reflect it. And then you say 27,960. When writing in an exam, we don't need to prove that 483,640 is a correct figure. I know it should be a correct figure. Okay, right. Now, so if I take 27 and I minus it from this one, it will give me this one here. Okay. So obviously it's the same thing here. Then what you then must always do, this figure here must always be seen here. Right. This figure here must always be here. Right. So in that line, I've already explained a few things. Okay. Now, let's then move to the statement of change in equity, which is our required 3. This one here. Now, statement of change in equity. Always show the share capital. You must always show the share capital of the holding company. In this case, it's banned. Always you show the capital, this one only. Right. Then we move to, let me go to non-controlling. Non-controlling, you'll see they're saying number 1, it's 84 plus 24. Ne? Now let's ask ourselves, what is this figure here? It's opening balance for this year, opening balance for 2011, meaning 1 January 2011. That's the opening balance. Now, if you go to here, at acquisition, when you acquired the company long time ago in 2009, you had non-controlling of 84. But that non-controlling by the beginning of the year, which is date number 2, we are sitting at 108. So you'll see 84 plus 24 is this 108 here, which is the 108 that you see here. and it's already explained by 84 and 24 here, right? Then after that, there was a 27,960, and you minus the dividends, then it took you to 123,960. Okay, here we go. Here's the 27, you minus the 12, it gives us the 123,960. Now, some of you don't get confused. You see this 15, it is the difference between these two figures here, right? And you'll see even the difference between these two is that 423 here, right? Now, I'm trying to look at something here. Okay, so what you need to know is that this one here must always tie to this one, but it should be the same because you are transferring figures. You are transferring figures that you see this side here. Look, if you look at this thing, it's from here to here. We are transferring figures, these figures that I've highlighted here, you are transferring them to here. So they must agree. Every time the two must agree. See, you'll see is 120, see here is 123,960. And even here is 123,960. Okay. Then we come to asset replacement. I'll do the retained earnings as the last thing. Asset replacement, the opening balance, I'm talking about this one. What you do, you say, what is asset replacement reserve of the holding company is 60. Let me just put it this way so that we don't get too confused. So it is 60 here, right? So you start by saying 60, and then you say plus what Ben is entitled to here in this date here. See this date here, in this date here, meaning what is he entitled to here, but what is only asset replacement, only what is asset replacement. I don't see asset replacement, I only see retained earnings in that line. So it's 0 because there's no asset replacement. So 60 plus 0 is 60, which is this one, right? There was never a movement of asset replacement reserve if you check the information given here. If you check the whole information that we have here, there's no movement of asset replacement, right, in the subsidiary. Because the subsidiary, if you check it, it started with asset replacement of 40 and it's still 40 even now. Nothing has changed. So your asset replacement reserve by end of the day is 60, the closing balance, right? Then we come to this one of retained earnings, right? Retained earnings, you say, what is the opening retained earnings of the holding company? Where is it? Here, 160. By beginning of the day, I've got 160. How much is Ben entitled to in Ken here until date number 2? Until date number 2, this one, because that's the beginning of the day. So 160 plus 56 plus the gain, this one here. Okay, plus that one. You'll see here it is 160 plus 56 plus 6. That should give you the one, let's see, 160 plus 56 plus 6. It's 222, 000. Here it is. 222, 000. Then the 483 I've already explained, which comes from here. The 60 I've already explained, which is this one here. So that gives us a closing of 645, 640. It is very important, students, to understand that we want to see these figures here, the totals. You see, sometimes the total column, this one is not that important, but from here, these figures, you must add them and give and show us these figures, because these figures, once you've added them, you will have to carry them here. Look at them, they're here, all of them. Okay, here they are. You see that? All these figures that you see at the top from here, they are the ones that we are transferring to here. So they represent principal marks when we are marking. Okay. Now, let's then deal with the whole thing of the balance sheet now. Here, it's not a problem. You add the holding plus the subsidiary, the holding plus the subsidiary. You do the same thing here. Let me do this. You do the same thing here. There's something that I want to address here. Let's start with this. I want to start with this one. Loan payable. Here it is. All right, there's a loan here that is payable. 100,000 plus 50,000. Okay. And then there's a loan that is receivable. This one, 54 plus 35. So I must remember, now, if you're borrowing people money, in your books, your loan is receivable, but the person who's receiving that money is loan payable, isn't it? So the first thing is you add the two figures. You will see here, here, 35 plus 54 plus 35, and then you've got 100 plus 50. Here, you add them. But now you'll see on both of them, there's a minus 50 and there's a minus 50. Remember, there's an intercompany transaction between the two. This one here. Here. Ken borrowed 50,000 from Ben. In Ken's book, it's a loan payable. In Ben Limited's book is a loan receivable. But the rules of consolidation says if you combine the two companies on consolidation, any transaction that is between the two of them, which is intercompany, it must be eliminated. So the 50,000 is intercompany. And remember I said it must be eliminated twice. You eliminate it under loan payable. And then you go and eliminate it under loan receivable. Because one is sitting with a loan receivable, one is sitting with a loan payable. Then you eliminate that intercompany transaction. I believe that you will now understand the principles of intercompany and what happens in relation to intercompany transaction, that on consolidation, they must be eliminated. Thank you.